there was an article that the Wall Street, or not the Wall Street Journal, that Bloomberg ran yesterday about the we've talked about this gold mark to market idea, or this gold revaluation idea that we believe is that Scott Bessent, our new Treasury Secretary, is behind, and we're close to some people that are advising him. And we think it's something that they are very much considering doing, the gold mark to market. And we've talked about it, we've written about it a little bit in letters to our investors. And it involves currently the price of gold statutorily on the books of the U.S. Treasury is marked at $42.22 an ounce. And folks who are advising the Treasury Secretary, including Zoltan Pozsar, have been and Stephen Miran, who's the new chairman of the Council of Economic Advisors, have been entertaining this idea of the gold mark to market, which is a way of effectively monetizing the difference between the statutory rate of $42 an ounce and the current market price of gold, which is closer to $2,900 an ounce, and the net effect of that is potentially a $750 billion gain on the Treasury's balance sheet that can potentially be monetized based upon what Pozsar and we think Bessent and Miran are considering, and it's effectively a repo of this unrealized gain of the $750 billion gain, by the Fed, whereby the Fed would credit that amount of money to the Treasury general account, and the idea is that, well, that's $750 billion less of Treasury issuance that the U.S. government would have to do in the next year, by doing this. Now, this article that came out in Bloomberg was almost as if it was being planted by somebody to really try to knock down this idea. And there was about what could really be done here with the gold revaluation, and they even quoted the Stephen Miran paper, the same paper that I referred to last week and that we linked in our letter, suggesting that after this mark-to-market gain, that the Treasury could sell the gold, that it was a serious option to sell the gold. Well, if you read the Stephen Miran paper, it was a total straw man. The only reason he suggested that idea was to knock it down, because of course, we're not going to be selling the gold, or at least, it's a pretty far-fetched idea. And the Bloomberg article even talked about they could swap the gold for bonds, because bonds pay interest, for bonds in another country's treasuries or something like that. And this Bloomberg article right here, which is pretty funny because I think that's the exact opposite plan that we understand the administration is seriously considering right now. I mean, I don't want to get into this in too much depth, but Trump is out there negotiating right now with the world leaders and trading partners and adversaries and NATO allies, and we've got tariffs on the table, and the goal is to the goal ultimately, this is negotiations, and the goal, as Treasury Secretary Bessent has said, is to get the 10-year yield down and yields across the whole curve down. One of the key objectives here, but they have a bigger agenda that Trump's advisors are considering. So we think it was very disingenuous in this article where they say that sources, within Trump's administration are not are not even considering this mark-to-market gold idea or taking it seriously. We think that's quite the opposite, and encourage you to to read some of read our last letters, read the Stephen Mirren paper more closely, and be more open-minded to what the administration is truly considering here. Let's go on to the just to point out real quickly, since there's a chart on this slide. The U.S. Treasury is the largest owner of any single entity on the planet of gold right now. 8.1 thousand tons of gold, and that's so this is important to understand. But it's important to understand that our European NATO allies collectively have a similar amount of gold in their reserves, and these are our NATO allies. And so there's a bigger plan here, because the gold to GDP of our NATO allies is even higher than the gold to GDP of US. So these swaps, and this idea of the US Treasury, issuing longer term bonds, maybe even century bonds, 100-year bonds, and swapping gold with NATO allies, I think this is the bigger play at hand. So meanwhile, gold equities. This is a chart. I think Tavia may have shared this one on Twitter or in one of our calls, but I just want to point out that gold equities have rarely been this cheap. This is looking at price to NAV for companies that have a mine plan, that have reserves and have a mine plan in place. There's something called the NAV that is an engineering and economic report study, where you can look at the present value of a deposit, and you can compare them to the current market price of the stock. And the point of showing this chart is that along the same lines of Tavi's chart, showing that margins, because of the price of some of the key energy commodities that go into the biggest cost component of mining is the energy cost, and the gold to oil ratio being at a record level is showing that mining companies have extraordinary margins and profitability right now, and at the same time they're trading at extraordinary discounts to their NAV. So this is just an incredible setup right now for mining companies that we believe are cheap, and it's also a setup for the what we call the M&A cycle. So let's go on to the next slide. And so we've done the study. I've showed this in the past. I just want to remind our viewers that on average, when a major mining company takes out an exploration company that has drilled out a gold resource, and the major mining company buys that whole company for that one discovery, on average, those firms get taken out for 17% of the resource value of the metal in the ground. That's at the median of all these examples over the last 15 or 20 years. And you can see in the green bars, in a bull market environment, the median acquisition price is 32% of the resource value of the metal in the ground. Neutral markets 17%, all markets 17%, bear markets 8%. We believe we are in a new bull market for precious metals and precious metals mining stocks. It has only just started. We've been through a 14-year bear market and consolidation for mining stocks since the peak of the mining industry back in 2011. And we think it's very early stages. And there are just a number of deeply undervalued mining companies out there. But the most deeply undervalued of them all, we believe, are in the exploration space. And that is, where the opportunity is as we get into an M&A cycle. And the M&A cycle is starting to pick up already. Let's go on to the next slide. So this is looking at our activist portfolio, which is the largest theme right now at Crescat across all of our funds. And this is looking at the activist portfolio outside of San Cristobal. San Cristobal is a private company that we invested in across our funds. It's been highly successful. It's one of the largest, it's like the number 4 largest producing silver mine in the world today. And they have a new discovery associated with it that is the Quentin has been super excited about. Our funds are the largest shareholder of San Cristobal, but we've had to put that into a side pocket because of the success that we have. But when you look outside of San Cristobal and the rest of our portfolio and the main fund, this activist portfolio is the largest theme across all of our funds: the precious metals fund, the global macro fund, the long short fund. It's the largest theme, and so this is just looking at the we have 69 different companies that we're invested in outside of San Cristobal. 37 of these companies have bona fide discoveries already: gold, silver, copper. These are discoveries where at least 25 of these, Quentin, our geologist, is extremely confident that these will become mines. They are so economic that they will become mines one day. And we're an activist strategy, so we own 9.7% of these companies. We have big activist stakes. At the meeting, we own 9.7% across the 69 stock portfolio. You can see in the maps that these deposits are located in friendly mining jurisdictions all around the world, and the map is showing both the relative size on the top map of the target gold equivalent ounces of our portfolio, and the bottom map is showing the number of drills. The size of the circles corresponds to the number of drills. Over the past 4 years, we have created this portfolio. We've been investing in this depressed industry that's been starved of capital, but we've been getting the money to these companies to do the drilling. We've had more greenfield drilling. Our companies have had more, across our portfolio, have done more greenfield drilling than all the major gold mining companies combined. So we have this killer portfolio of new discoveries and incipient discoveries, whereby we have been able to create, outside of San Cristobal, we've been able to create 224 million target gold equivalent ounces of gold, silver, copper, zinc, nickel, manganese, and this is an enormous amount of gold in the ground. These are based on Quentin's geologic estimates, and our portfolio is still so deeply undervalued today relative to these estimates, and relative to that M&A takeout chart that we just showed. So are all of our companies going to get taken out by major mining companies? No, they're not, but we think some of them will. And there is a big divergence in the current valuation, which is, frankly, the valuation is trading less than 0.5% of Quentin's estimates for the resource value based upon the drilling to date. We are just really excited about this portfolio. Now, people will say, well, Crescat, you guys have been underperforming. Your precious metals fund has been underperforming gold and even the major mining companies in the past few years, and that's true. But I'm here to tell you that our performance is starting to pick up again, and we were up over 14% last month in the precious metals fund. Our global macro and net of fees, our global macro and our long short funds were up over 15%, where we also have some short positions that we're adding value to above and beyond the activist metals portfolio. And Crescat is starting to perform again. Let's go on to the next slide, because this looks at the performance of the precious metals fund, net of fees, since inception 4.5 years ago. Now people will say, But Crescat, you've been underperforming recently, but you look at the total since inception performance of our funds versus all the various gold benchmarks, whether it's Philadelphia Gold and Silver Stock Exchange, that's the large cap gold and silver benchmark that have U.S. listed securities. You look at the Spider Gold shares, that's the ETF that just owns gold. Tavi was showing a chart on that, or the SLV, the Silver Trust that is just silver. The Van Eck Junior Gold Miners, a little bit of a misnomer. People think those are explorers, but they're really not. They're mid-cap producers for the most part in the GDXJ, the Junior Gold Mining Index, or the more senior ETF, the GDX, which is kind of like the Philadelphia Gold and Silver Index. This looks at the annualized performance since inception of all of these different benchmarks versus Crescat's fund. Our fund is up 19.3% net annualized. We've started to outperform the benchmarks again recently, like we did in January, and like this is the X side pocket performance, by the way. So this is what new investors coming into the fund are able to get, because new investors cannot participate in San Cristobal. You can read that disclosure down at the bottom to understand more about that, or go to those links on our website to see the total performance of the fund, including the side pocket, excluding the side pocket. I'm just here to tell folks that Crescat has been starting to outperform again, and when you look at our total performance since inception, we have outperformed the benchmarks substantially. I am really excited about the portfolio that we've built over the last 4 years. I think there's incredible opportunity still to put money to work in this space right now at this time, ahead of some really exciting macro tailwinds that we have, like we've been talking about with this potential gold mark to market. Let's go on to the next. So one thing that we notice is that the year to date, and there's only year to date, there's only been a couple of weeks so far, but these over the weekends, the S&P performance has been slipping quite significantly. This is something that Bloomberg was highlighting today. Just thought we would show this, because, as you know, we still believe that we are in the midst of a rotation out of mega cap tech stocks and large cap growth stocks and into undervalued value stocks and commodity stocks, and precious metals. We are not giving up in our global macro and in our long short fund on the short theme that we have with respect to the mega cap tech stocks. Let's go on to the next. So B of A put out this chart looking at the total allocation among all mutual funds, all equity fund assets under management. And this is B of A Global Research. It's looking at active versus passive management. So one of the drivers really of this this large cap growth stock and mega cap tech outperformance over the past several years, we think has been driven by passive assets under management flows. And you can see that passive has overtaken active in terms of the distribution of managed money out there. So look, I went to the University of Chicago. University of Chicago is famous for one of the professors there, Eugene Fama, who's one of who's kind of the founding father of the efficient market hypothesis, and which states that markets are efficient, and therefore essentially don't bother trying to do fundamental analysis and beat the stock market, because you can't. And of course, this idea challenged me because I just frankly didn't believe it, didn't buy into it. That's why I'm an active manager. That's why I got into this business. That's why I've sought to prove over all the years that I've been in the business that we can outperform the S&P 500. But look, passive has had an incredible run. And But this is part of the imbalance today. And what is this imbalance? Let's go on to the next chart. It's called the Grossman-Stiglitz paradox. And these guys, Sanford Grossman and Joseph Stiglitz, this is one of the papers that I studied when I was in business school in 1992. They came up with this, with their theory that, that argues that perfectly informationally efficient markets are an impossibility, because if prices perfectly reflected all available information, which is Fama's efficient market hypothesis, there is no profit to gathering information, in which case there would be little reason to trade and markets would eventually collapse. Well, this is kind of the idea and the tension when too many people are on one side of the boat, passive. Who's doing the fundamental analysis? And that's why you can have these divergences, like Tavi was showing, where the earnings estimates for the NASDAQ 100 are coming down at the same time as the stock prices are still going up. It's because the flows just keep coming into passive investment, every biweekly paycheck, and because these indices are market cap weighted, more money keeps going into the biggest stocks, and it's like who's running the, who's actually doing the security analysis out there today. So, I'm not giving up on doing the security analysis, on trying to outperform the market. Our strategies have outperformed the markets over long time frames. We've had some underperformance recently, no doubt. But that's because we're different. We're not just chasing the passive indices. We're long, we're short, we're value investors. We have counter-cyclical ideas. We're contrarian. And over time, we believe that's something that pays off. Let's go on to the next. Here, Nathaniel thought this was an interesting chart. He's one of our analysts, so I just wanted to show that after that retail sales number today, which Tavi was talking about, kind of showing some stagflation, that the expected, there's a whole nother rate cut priced into the market now, expected for this year in 2025. So that, that's how important, this fundamental macro data is to the markets and the interest rate markets, and this idea of stagflation. Stock market, not paying attention to this kind of stuff, because here we are retesting the highs of the S&P 500 and the NASDAQ 100 today. It's pretty crazy. But remember that weekend phenomenon that's been happening. Things, we'll see what happens on Monday. Anyway, let's go on to the next, my last chart here. This is, to get back to this idea of the Grossman-Stiglitz paradox, and why it may not be the smartest thing to just be, long and passive, because that's what's worked. And, Grossman and Stiglitz said no. Eventually, that doesn't work. If nobody was minding the farm and everyone was just passive, the whole market would collapse. Well, this is showing the Global Macro Fund, the Crescat Global Macro Fund, which has a 19-year track record now, and it's showing one thing that's different about what we do here. We're not just a long-only global macro fund. We're contrarian. We're value investors. We're macro investors. We have short positions. We take contrarian stances and long positions in things like gold. Our fund has had what is called a negative downside capture ratio versus both the S&P 500 and versus the HFRX Global Hedge Fund Index since inception 19 years ago. What does this mean? What's a negative downside capture ratio mean? It means that on average, when markets go down on down months over this 19-year history of down months in our global macro hedge fund, our fund has actually gone up during those down months. Well, that's kind of unique. That's kind of different. And past performance is no guarantee of future returns, but this is a reflection of our mindset and how we think and how we position the portfolio. We're not afraid to be contrarians. We're not afraid to have short positions. We're not afraid to own value investments, even when growth in large cap and mega cap tech has been in favor. And how has that played out historically? Well, in down, and there have been a lot of down months over the last 20 years. We've been through the global financial crisis. We've been through other choppy market periods, whether it was the COVID 2020 recession and blip recession in 2020, and on average, or whether it was a 2014 2015 year period that was a pretty choppy period. Other events like Volmageddon, we on average, our fund has gone up in a down market. So I'm just pointing this to people's attention that this is something different. Maybe it's time for people to be considering something different in their portfolio allocations, and something different than just getting long the Magnificent Seven, just getting long passive investing. Valuations are expensive. We've shown a number of times in the past. I'm not going to dwell on it here. The valuations of the S&P 500 and the NASDAQ 100 and the Mag 7 are historically stretched. The market concentration, this is a risk. Maybe it's time to look at something different in your portfolio allocation. And that's what we offer here at Crescat.